Advance runs a multi-manager investment philosophy. What this means is that we invest in a whole lot of managers, sort of a fund of funds approach.
We blend different asset classes together and different managers to deliver a return that we believe is sustainable above the benchmark.
We also wish to emphasise our philosophy of being able to protect investors' capital.
We need transparency and just a high degree of risk management.
The primary objective here is to preserve and enhance capital of our clients in a world that's full of turmoil and turbulence.
We don't tend to go into a lot of complex type structured solutions. We actually set and construct portfolios that are going to be able to deliver. The asset classes that we look at, particularly around what is going to deliver the outcome that we need, and not all asset classes will be able to deliver that.
I don't fall in love with any asset class. To me, I'm a very pragmatic investor. I look across the entire spectrum, like I said, of asset classes and figure out which is going to be the best asset class to be in.
We need to focus on what our long-term objectives are, but in this sort of market environment, you also have to be cognizant of the fact that you're just not going to get that short-term delivery.
The world that we are in, which I describe as short, sharp cycles, it becomes even more important to have a pragmatic and a dynamic approach to asset allocation and strategy.
We see risk as an opportunity. We also view risk as something that needs to have the first focus when investing in investment markets.
We try very hard not to have a concentration of risk in any one particular area.
By carefully looking at the investment philosophies of our managers, carefully looking at the portfolio managers.
Appointing different managers that have different investment approaches, philosophies and styles.
And then drilling right down and looking at the various securities that are in the portfolio and looking at the volatility of those securities, so when we build it up, we see in aggregate what impact or potential impact it will have on the portfolio, which is very important for clients.
The other way of diversifying risk or managing risk is by looking at the blend of those managers with one another. So what we do is we look at the correlations of returns of those managers.
Investment is managing risk efficiently and the returns look after themselves. A whole heap of things. We are in a world that is extremely turbulent and volatile. The dysfunctional global political system won. The inability of elected leaders to make decisions because either they lack the foresight or the insight or the skills to do it. So investors are in a world that is so uncertain and turbulent.
Most of the investors in the world like picking companies, like picking stocks, like doing the bottom-up work and identifying which businesses do they want to be part of. At the same time, we have an environment and an umbrella above which is really kind of making these companies quite fearful about how they should be investing their own capital. When they're fearful, investors are fearful, and it becomes a bit of a difficult environment to sort of predict.
There have been a number of key challenges, and it's the way that people react to those sorts of things. So, you know, we've obviously had the tech wreck in 2000, we've had the trade centre attacks basically in 2001. Then you have the sort of GFC coming through. It's a situation where, yes, the markets have been pounded and pounded and pounded. And we've sort of got to view the fact that the investment stories that have been driven at the moment are driven more so out of people's emotions, not necessarily out of the fundamental view that a company is going to go up or it's a great outcome and all those sorts of things. So having a bit more of a behavioural sort of aspect to the way the markets are performing is a very, very important part of an investment function going forward.